Hi everybody, welcome to M Talks. This is Nikhil Mani.
This is Bibin Michael. This is our 20th or 21st episode, right?
This is our 21st episode.
Man, it's how many? Almost it's like we started 6 months, right?
Around 6 months, yeah.
Getting 6 months.
Getting to be around 6 months,
Wow.
yeah. And our viewership's going down and down. No, it's just because we've been busy, we don't promote it as much.
Yeah, we need to pay attention on how to promote it properly.
Definitely.
So usually when you hear that, right, people always emailing you. Oh, we will promote. I've been getting.
I actually got an email too about that marketing thing.
All right.
And going back to the conversation, so we talked about universal life last episode, and we talked about, and then a little bit of IUL, and we talked about 5 to 9, and how IUL can like kind of assist, instead of like using a 5 to 9 instead of using a 5 to 9, maybe using an IUL might be beneficial.
Sure. So before you jump into IUL, when you talk about 529, right? There's a new update on 2024.
Yeah.
Actually, we didn't mention that last time.
Right.
So the 2024.
Well, that update literally came like the day after we shot our episode.
Right.
So
yeah. It's a brand new update
regarding the 5 to 9. Yeah, but it's not like, I don't think it really. Oh, go ahead. Tell people what the update is for the 5 to 9.
The update is actually if you have a 529 unused 529 money that college fund you funded, and it's been funding for more than 15 years. And if
at least 15 years.
At least minimum 15 years you've been funding. And if you are not using the money, who are the beneficiary, you can convert on their name
into their IRA accounts.
Into Roth IRA.
Yeah. Okay.
529 is tax free, right?
Right.
So you can convert that into Roth IRA without affecting any tax.
Having any tax implications.
Correct.
So basically, there's a little bit more in-depth questions we have to ask about these things, because does that mean that the Roth IRA at that time, the limit has been, is there any limitations to how much you can roll over? Are you rolling over the entire amount of the 529? So
the rolling over will be entire amount. It's similar to, it sounds like a similar, but we need to get like a more information on that specifically. But usually, even though there's a lot of, pretty much all the, the cash value insurances have a limit that you cannot put more than certain amount. But if you are bringing money from another insurance,
it doesn't matter.
You can put it. So it might be affecting similar to that. But we will go in deep and we'll. If you have any unused for 529 for your plan for kids' college education, and
that you started 15 years ago, and it's just sitting there, and your kids didn't use it. You can put it towards your kids'
scholarship, or didn't use for any reason, and you're trying to cash it out.
It goes into the beneficiaries, not who's.
It's only to the beneficiary. But if you are about to cash out or something, then there's an opportunity this year onwards. You will be able to convert into a Roth IRA in your beneficiary's name. So that is actually a good change.
It is, yeah, because I think you have qualified expenses that you can withdraw from in a Roth IRA.
Correct.
So then, in an event of if your kid is trying to buy a house at that point, and if he has this money that's in the 529 he couldn't touch, now he can touch it.
He can convert it, and he can take
a loan out of it. Yeah.
So
or I think you can cash. Actually, you can cash it out.
Cash it out. You don't need a loan.
You don't need a loan. Yeah, you can cash it out because Anyways,
so that's actually a good news. If anybody having those, think about it.
That's a good functional update.
Correct.
For
instead of wasting penalty and all, maybe that will be a good
worrying
good
about
choice.
Penalties. Yeah.
Correct. So talk about IUL.
How does IUL? How can people structure their IUL and use that instead of a 5 to 9, right? Because at the end of the day, it's the same thing. It's post-tax dollars going in, isn't it?
Correct.
Right. So like you're paying taxes on the 5 to 9 money that you're putting in, right? You're not getting a tax benefit when you put the money in.
No, the growth is tax-free.
That's it. So. And the rate of return is it's on the variable market.
It's on the variable market, similar to 401k.
Looks similar to 401k. So there's no guaranteed
no way
growth. It can go up, it can go down, whatever. Depends on how actively you're managing these products, right? Now, how do you use the IUL to supplement this or to replace this?
I believe we went through a little bit about IUL, right?
I think so, yeah.
Right, the premium what you pay.
Yeah. and the
money
investment
going
amount,
in as a premium, coming out as a loan.
Right.
The money you're putting in premium, you get insurance coverage. Plus, there's you in all life there used to be a kind of like similar to savings account, but in IUL you'll be able to use that savings account money to grow in the market in index strategy. So by using index strategy, the main advantage is actually you will get the market growth. So you can participate with the market growth. But if
you will get a growth that's proportional to the market growth.
Proportional.
Yeah.
If growth is happening in the market, you will get the growth.
Yeah.
And if the market is crashing out there, what point you are at that time, like you will
the
be
money stays fixed. It doesn't go down.
You don't go down. So basically, you can use the upside potential and the downside protection. That is a easy definition of index strategy. And the good news is actually in the IULs, we will be able to utilize that strategy. So where you can grow money, also you can get the protection. And there's a lot of riders into it, like IULs is actually comes out as it's a default riders in their terminal illness, chronic illness, critical illness covered.
So that's all included already in the premiums?
Correct.
You don't have to check. You don't have to
add. It's not add-on features. It's already in there. And
so what do you add on?
Add-on feature is actually for the long-term care. So before that, anything proceed with the IUL. Let me give you a disclaimer that IUL is not for everybody. It's not for everybody. If you're looking for a protection, IUL may be not that great product.
Term life is.
Term life will be better product. And also, if you are not making money, maybe IUL not a option. If someone is not designing you properly, maybe IUL is not a right product.
Right. You can't be setting up your IUL where you're putting $500 a month in just premiums. Right. That's how people do it. So
it's purely depends on an expert how to design it.
Right.
That's what it is. Right. So usually, anybody can give you a IUL. Whoever have a license may be able to. But it's going to be worth getting from anybody. My answer will be no.
Yeah, you have to get it with someone who knows how to write the policy that's for the benefit of the customer, not for him getting a big commission check.
Right. So I don't know. It's going to be a controversial point. Controversial if I say this out loud. But anybody who sell outside insurance may be not the right person to sell you IUL. Those who design for investment purpose, insurance, then maybe potentially possible. So it's not like insurance is never an insurance tool. I mean the investment tool. You cannot even say out loud like that. But there are some features you can utilize to grow money.
Right.
And the market potential you can utilize, and the down market protection you can utilize, and the money what you grow inside the insurance is actually tax free too. So lot of features inside this small product. So by saying that this product is like a huge product.
It's a wonderful product, but it has to be structured right.
It has to be structured.
It has, right. And what Bibin's trying to say is you need to go with someone who knows how to write the product for the benefit of the client, not for his benefit. Because at the end of the day, the more premium you're paying means the more commission that agent is making.
Not really. No, that's not true. So basically, there is something called set rate for any product you design. So depends on that amount is the income will be going.
Right.
Even you're gonna put like 100,000 a year, or you're putting 20,000 a year. Doesn't really matter how big the product is. Depends on the income will be coming. So not anybody can do like that, but the money what you're putting inside an IUL, if you need to be grown proper, if you need to grow that money properly, you have to design it properly.
So there's no premium, there's no incentive for these agents to write these products in the favor of like, okay, if I'm doing let's just say like I want to put $500 away, right? And I know like to access a $500,000 insurance in IUL, if you're less than 35, your premium is probably going to be around $150, right? But wouldn't that agent be making more money if he didn't write it up the right way and he put the premium as $500 instead of the...
So I will put like this.
And so
You can-
basically what I'm trying to say is this. Okay, for $500,000, I know that the protection is costing me $150 a month, right? But if he writes me a protection for $1.5 million, right? And I know I only have $500 and people don't know this, then he makes more money.
The statement you said is correct.
Right.
So the money you're putting in IUL, if you don't design it properly,
It's all going to go into your premium,
correct.
which will not benefit anybody. And you're paying way more than what you would for a term life protection.
But the problem is actually not. I don't think anybody would do like that. But if the client don't know about this product, and if they simply say asking for a certain amount of coverage, and if the agent is not educating them properly how this works, and if you go for this kind of coverage, the money what you're putting in
It's
might
too
be
much.
all going towards the cost.
Yeah.
If the client is not know any of those things, he can easily
Just lose.
decide very wrong.
Yeah, no, at the end of the day, like the right way of doing things is with regards to protection plans, right? My understanding is it has to be with a mixture of products, right? It's not just 100% reliant on a index policy or 100% reliant on a term policy. You need to have a mix of both. And
so the good point you mentioned, Nikhil. So how are you going to find out these things? How you will be able to find out these things is actually
talk to an expert like you.
Not only that though. So I don't know about my clients, right? If somebody asks me I need coverage, I cannot simply give them the coverage. So I have to go through a session called financial analysis. Then only I will get an idea that why they need coverage and what's their mindset, like what reason they're looking for coverage or what reason they're looking to grow money. So without knowing their purpose or their risk appetite or their time horizon, I don't know how long time they have to grow money. So without knowing all these things, it's going to be...
You can't really design or sell a product if you don't know any of that.
Just take an example. Nikhil, you walking in today and telling me, Bibin, I need an IUL or I need a coverage of 2 million. I can simply, with my ability, I can easily find a product and give you that. But instead of I give you that, I can easily sit with you maybe 30 minutes and find out why you're looking for that coverage. And if I know the reason or the purpose you're looking for coverage, I may be able to help you way better than what I was capable without doing that. So if I know things, I can do better.
Yeah.
So that's why we always suggest
having a sit down.
Yeah, don't go anywhere and don't purchase a product. So this is not simply like you purchase from Amazon or something, a TV or a cell phone. No, this is actually a lot of things involved, especially money involved and the protection involved and a lot of other features involved. So if you don't design it properly, maybe
you're losing money because
maybe this is not for you.
Right.
So
and it's going back to the IUL, right? So when you set it up the way ideally you set up, right? The idea is you can put in more than your premium up to a limit of whatever your policy allows you to do, right? And then that money you could take it almost at a zero interest loan. How does that work after 10 years of it being invested?
I remember I mentioned about the loan and interest rate on about all life on our life insurance first episode, I believe, right?
Yeah.
So over there in our all life insurance, if you are listening to me and you have an all life insurance, you can expect if you take money out from it, you may be paying up to 5.5% interest. Where you pay the money to or where you pay the interest to. The interest goes to the company, not to your account or not to your money. So the money clearly is not for you. The money is if you stop paying on the all life insurance, the premium, this account, whatever the accumulation is called cash value, the company will be using the cash value to run your insurance. So you will have lifelong insurance. That is the purpose. So if you take money out, you have to pay interest. Coming back to IUL. IUL also, all the insurance have similar features. IUL also have a death benefit like any other insurance. and also have a cash value similar to all life, but the money is not actually adding like by dividends, growing in the market with the index strategy, the potential for market potential and the downside protection. So that money accumulated, you will be able to withdraw in the form of a loan. So 100%, any insurance you put money in as premium, out as a loan, or you have to be cancelling or surrendering the policy and get the money out. This is the only two forms. So if you're taking money out as a loan, there will be interest charges. But when you compare with the all life insurance, it's entirely different. It's two different books, right? So one book is actually entire money. Anytime you take money out, 5.5 up to 5.5 interest rate. So this book actually says if you take money out on the first 5 years, they will charge you 2% interest rate.
Okay.
And 6 to 10 years, they will charge you 1% interest rate. 11th year onwards, 0% interest rate. So basically, if you can invest money in your IUL and 10 years, and 11th year onwards, if you want to take money out, you can without any interest.
But it's a loan.
Absolutely.
You don't do a cash withdrawal because
absolutely
you pay do you pay taxes on that then?
No,
on
you
that
don't.
growth.
You don't.
If it's a cash withdrawal, you don't.
Cash withdrawal, there's no way you can cash withdraw. If you need,
you have to surrender
it. If you're surrendering and the life insurance is not active anymore, whatever the premium you paid, any penny you made, if it's in the cash value, right. Just take an example. You paid maybe 20 years, over the 20-year period, you paid $100,000 as a premium.
Right.
And your money right now is $300,000. And you're closing the policy and surrendering the policy and taking money out, that $300,000 you can take out. It's in your cash value.
Okay.
But at that point, your policy is not active. So the $200,000 extra or the growth you made will be taxable.
See, that's what okay, got it.
That will be taxable if you surrender it.
If you surrender it.
But in case if you take the same $200,000 out from it
that's
as a loan,
that's at 0%.
0%, no interest and no tax.
Okay. This strategy is what people sell to the public as infinite banking, right?
The infinite banking actually using in what do you call the term is actually came out connected with the all life,
right?
But it will be wonderful if you use the term only in IUL.
In IUL because it's more practical with an IUL.
More practical with IUL.
Because what I just to kind of
it's
explain
also
that
like a be your own bank.
Being your own bank basically. So this is where I tell my friends and family like, if you have an IUL, you can basically put your long-term savings into an IUL. You don't have to put your long-term savings in a regular bank account.
Correct.
Where it's growing for less than
the regular bank. This is how you differentiate things. The regular bank account is only for emergency purpose. Your emergency money has to be in the bank.
That's it.
Because you go there, you get
your
the money.
long-term savings has to be
anything else.
in like
you
an
have
IUL.
To, you have to categorize your money, and you have to place it properly.
Right. And doing that, real life stories of people that after 10 years they're self-sufficient because they don't have to go take a loan outside of their own policy. They can just take money to buy a car, and then they just pay themselves. But here's you need discipline in all of this, right? But what smart people do is that if you have a policy, or if you create a policy for a kid or for a child of yours, and in 15 years time, when that child is either going into college or coming out of college, or has any expenditure that he needs to go into the market to like buy something, he doesn't have to take a market loan out. What he should rather do is take a loan out of his policy, pay 0% interest on it, so he can buy something outright cash, and then have the discipline to pay back the policy with interest.
So let me add on to that.
Mm-hmm.
I will add one story. So I know somebody here used to live in New Jersey, but recently moved to Georgia, Atlanta, Georgia, Korean. So he had a policy, like a 12-year-old policy. 12 years back he designed this. And when he moved to Georgia, so he started a chicken wing store. So what he did, he loaned the money from
His life policy.
his life insurance, and he started the business, and he's paying back. So I met him like I believe a year ago.
Okay.
He used to be here, right? So he was at the office, and he was showing me I went through his account and went through how that process was happening. Phenomenal. It's actually what he did. Like he put money back in. It's majority of the money back in already because
Plus interest.
and the money what he used to build a new business.
Right.
And from the income from the business, he's paying back.
His policy.
So that is a way creative way of doing it. What he's supposed to be doing if he don't have that product.
Right.
He'll be lending money from a bank.
And he's probably at that. This is last year.
This was maybe 2 years ago.
So 2 years ago, he was paying about what 4%?
About
4.5%.
4.5%.
That's crazy.
And here, this is already 12th year, so he's paying
0%. That's awesome.
So that's the only thing here I would like to emphasize, guys. We do have resources out here. We do. Believe me, there are financial services available out here that we can utilize properly to grow our money, secure our money, protect our money properly. There is available out in the market. The only thing is we are not there to access it. That's all.
Or we don't know enough, or we don't want to talk about finances with people that can help us with our finances in the fear of they're making money off us.
Right. So that is the thing. So what's stopping us is actually our not ignorance, but our lack of knowledge in this topic.
Right.
So get to know more and
call us, message us, call us, and we'd love to assess your family situation and give you guys the right recommendations, and hopefully give you guys
by saying that you don't need to purchase from us.
Yeah, you don't have to.
No, you don't have to.
We'll definitely give you the right recommendations though.
Right.
I think we're gonna have another episode.
So we will finalize the next episode. We'll talk more about a little bit more deeper into IUL, and we'll finalize there. And like I mentioned earlier, that is a wonderful product out there. A lot of families getting benefited, a lot of business people getting benefited, and you can grow money tax free out in the market. A lot of resources available,
and you can be your own bank. I think that's like the biggest thing if people think about it. If instead of depending on an outside funding source, you can rely on yourself if you're able to put money aside for the next 10 years.
Exactly. The money is growing out in the properly. It's 100% protected. A lot of other features also included. And also, if you want to do something down the line, just think about you have a 200,000 accumulated in your in your IUL account, and you want to buy a property and you want to put a down payment 100,000. Take it out. Put down payment, purchase the land, and pay back. Or if you don't want to pay back, your growth will be
discounted at
that point. Otherwise, you're good to go. So you can utilize properly, but the key point here will be discipline. You need to have some discipline on how to manage your money. That's all. That's all is required. Everything else available out in the market. Reach out to us, and we'll go from there.
Thanks, guys.
Thank you.